You said, quote, "I believe Bitcoin is the biggest trade of our generation. Bitcoin is a serial killer. It's going to go through 40 or 50 different industries. It's the final piece of the protocol puzzle that is the internet, and that's massive."
I love that you put that serial killer line. One of the reasons I love using it is to remind people it will happen serially. It's not gonna all happen overnight. In the bubbles and the manias, everybody thinks, Bitcoin blockchain is gonna change the world overnight. And then, when it goes down 80 or 90% like it has many times, people are like, oh, it failed, it didn't do anything. In reality, it's slowly marching through hundreds of different use cases. The main thing is just get involved. Join your college Bitcoin club or blockchain club. Start reading, there's a ton of great stuff to read these days. There's a great Mark Twain line that I never let my schooling get in the way of my education. And that's what I would suggest to kids like your daughter. Go to college, have a great time, learn all those things you need to learn, relationships, all this important stuff, and then go get a job in Bitcoin or something else. But those 4 years are super important for lots of other reasons. And you can learn all the rest of this on the job. I didn't study Bitcoin in college. It might take people 5 or 10 years to get their head around it, but once they buy Bitcoin or other cryptocurrencies, they almost never want to sell it. And that's why the price just keeps going up, because there's very few people that ever want to part with it. There's 3.5 billion people on Earth with a smartphone. If all those people started using cryptocurrency and that relationship held, which, the past doesn't have to predict the future, but it seems solid, that's $700,000 per Bitcoin.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go?
This is London Real. I am Brian Rose. My guest today is...
This is London Real. I am Brian Rose. My guest today is Dan Morehead, the American hedge fund manager and financial advisor who has become one of the leading figures in the world of cryptocurrency and decentralized finance. After graduating from Princeton University, you spent over 15 years working at some of the world's leading financial institutions, including Goldman Sachs, Bankers Trust, and Deutsche Bank. Then, in 2003, you founded the global macro hedge fund Pantera Capital, and in 2013, shifted your focus solely to blockchain and cryptocurrency. Today, you manage $2.8 billion in blockchain-related assets and have invested in many crypto and DeFi companies, including Bitstamp, Coinbase, Polkadot, Blockfolio, and Audius. You have described DeFi as one of the biggest opportunities in the blockchain industry, suggesting that it, quote, has the potential to grow 100 times more than Bitcoin in the next 3 to 5 years. Dan, welcome to London Real.
Hey, Brian, thanks for having me.
Hey, it's great to have you here. And so much to talk about today, from funds to your early adoption of Bitcoin and in the space. Before we get started, I wanted to do a little memory lane with you because I started my career on Wall Street in 1993. I graduated with a mechanical engineering degree. I think you were civil engineering. And it was the guys at Bankers Trust that recruited me. So I was at Bankers Trust when you were there from 1993 to 1995. I was on the 33rd floor on the fixed income derivatives desk. And Dan, it was a pivotal moment in my life. I learned so much on that trading floor. It was madness. I see you cracking a smile there. There were things said on that floor that are so politically incorrect today. It was so alpha, but there was so much learning at the same time. I remember I was interviewed by Ari Bergman. I went to work for Bill Hirschberg. There were a bunch of 20-something-year-old guys that had come back from Tokyo that were running these big books, and they taught me so much. They also verbally abused me and whipped me into shape. But I'm wondering what you remember from your days at Bankers Trust and being on those trading floors. I can't imagine these days how you do that via Zoom. But what do you remember from those days, and do you think those were great places to learn?
Oh, I do. Trading floors were so fun. 300-400 people, all just kind of bashing about with a ton of money and risk on the line. It was really fun. Everything being done by a robot now is a little less interesting. I think, for young guys like you and me, it was a great time to learn because you had all these, seasoned professionals that were screaming about prices, across entire trading floors. And yes, probably some off-color remarks here and there. So it, made it spicy and fun. But the environment, particularly Bankers Trust, was so fun because it was a very dynamic place. The two guys you mentioned were great. And then the CEO was, Gene Shanks was allowing lots of very interesting things to happen. So you could create new markets. And, at the time you were there, we were all creating the derivatives market. And so it's a completely new asset class. It's changed the world. It's a very important thing. And that kind of, you roll the movie forward, 20 years, and blockchain is a new asset class. So there's a lot of analogs we can talk about later. But the trading floor environment was so fun. Flying around the world, going to Kuala Lumpur and all these places looking for interesting trades. That was a great time.
Yeah, I try to describe the culture of Bankers Trust, and it was almost, it didn't have a history, steeped in tradition. It was kind of like, we got this balance sheet, we got a bunch of smart people, we got great models, and if you can create something that'll make a lot of money and work, then we're going to give you as much rope as you can. That's kind of the feeling I had when I got there. Am I about right?
No, you're right, because I actually started out as a CMO trader and asset-backed trader at Goldman. And, obviously Goldman does have the steep tradition, and everyone kind of did their, one little thing. And I was actually the first asset-backed securities trader there, credit cards, auto loans. That was a new thing. And I was just the most junior guy on the desk. I kind of did my little thing. It was fun. I sat next to Steve Mnuchin and, some other treasury secretaries were my bosses. And so, it was a fun environment, but literally I did the same thing every day. And I didn't really learn that much because I just kind of tried to be good at trading a few asset backs, but I didn't really progress my career much. And when I switched to Bankers Trust, it was like the Wild West. Anybody could start a whole mortgage derivatives unit. I hadn't even heard of derivatives basically before I got there. And a lot of creative people, so it was a really dynamic, fun time to learn.
Yeah, I was 22.
And you mentioned Tokyo. I did spend a year and a half, 91, 92 in Tokyo. That was a formative time because Japan was just entering what we now know as the normal new environment. But at the time it seemed, shocking to have rates below 6%. Japanese overnight rates were 6% when I was in Japan. And they were just getting their heads around what they thought at the time was, quote, a Japanese recession, so sub 3% growth. And having seen the devastation in the Nikkei collapse, with overnight rates at 6% and the economy in a free fall, I was like, no, I think this is like a real recession. And that was 30 years ago. And the world now has all those things they invented: ZIRP, zero interest rate policy, quantitative easing, all the things that were invented in the early 90s in Japan have, now are the normal for everywhere.
Yeah, wow. It's weird how that kind of almost foreshadowed what was going on. And Bankers Trust was quite big in Tokyo. I think you probably were working with Kent Kurtz out there, who got moved back to New York right when I joined, and that whole environment. And at BT, you're right. I was 22 years old and I sat down on the fixed floating desk and they said, here's a phone, goes to the Chicago Mercantile Exchange. Here's one to the Board of Trades. Here's the squawk box to the Treasury guys. You're going to price this fixed floating swap right now, 5 years, to this maturity date, to this, and quote it on 50 million notional, go. And I was just like, are you kidding me, And I think 6 months later, one of the MDs left and I was running the fixed floating swap book for a little while at 23. And this was like normal at BT, right? So it was a fun place to be and a fun place to learn. And like you said, there was so much innovation going on that desk. We were doing time trades and all these fantastic, interesting custom-made derivatives. And strangely enough, Dan, when I looked at the DeFi market about 6 months ago, I said, these guys seem to be doing the kind of innovation that felt like what we were doing at Bankers Trust in the 90s. And I had just a weird flashback and thought, but these men and women today in DeFi, and we'll get to that, they don't need a balance sheet. They don't need 10,000 employees. They don't need a line with the Fed. They don't need all this stuff. They can be 4 guys, a girl, and a dog in Tel Aviv, and boom, Uniswap's up and we're testing it. And I just thought, wow, this is incredible how fast it's growing, the rate of innovation. and then the customer is the winner in the end. It would never happen this fast in the centralized finance institution, even with Bankers Trust and Goldman traders. And that's what really attracted me to this place. And I don't know if you ever see parallels in that, but that's what pulled me into this space this time.
Oh, I do. And it's just such a fascinating space because, blockchain is impacting not just decentralized finance, but like 100 other applications. So every day there's something fascinating. And, honestly, my head's about to explode all the information I'm trying to cram in there. There's so many cool things going on. So I feel grateful actually to be alive and working in this time, right? When we look back 20, 30 years from now, this can be seen as one of the most important times in finance.
Yeah, I really feel like we're part of history, and I haven't felt like that too many times in my life. So, it's fascinating to hear that after 8 years investing in this business, your head's still about to explode. That's a great sign. I wanted to kick it off. We got a lot to talk about, but maybe we start with Bitcoin because it was one of the first things you learned about. I think you had a 4-hour coffee with someone that turned into a day when you first learned about it. You were one of the very first people to create a fund that would invest in this instrument back when nobody was even talking about it, and you were really early. You've said a few things about Bitcoin. I'm just going to quote you back and then give it over to you. You said, quote, "I believe Bitcoin is the biggest trade of our generation." You've said Bitcoin is a serial killer. It's going to go through 40 or 50 different industries. And then one of my favorite quotes from you is you said it's the final piece of the protocol puzzle that is the internet. Even in the 1990s, the famous economist Milton Friedman said the only thing missing from the internet was an e-cash system. That's what Bitcoin is. That's what the other blockchains are. It's just a protocol for moving data around, and that's massive. Dan, how do you start this conversation, and how do you talk about Bitcoin to people that are newish to it or know a little bit about it?
Yeah, it's a good question. And, I've tried so many different angles over the years to explain Bitcoin, and it really is true that everyone has their own light bulb moment. There's a lot of different perspectives people have. Like if you find a gold bug, explain it in 2 seconds. They're like, great, got it, I'm in. But there's other people who are way more skeptical, think, we already have a currency in the United States, why do we need another one? So, there's like so many different angles. I do think the concept of it being the final piece of the protocol puzzle that is the internet is one that really helps people get their head around it, because most of us don't know a ton about the internet, but we know there's a bunch of protocols like TCP/IP that help move data around. But we needed a finance one, right? And the internet changed everything else in our lives, commerce, communication, all that. But it really didn't touch finance, right? Banks are basically the way they were when the Medici set them up. Credit cards been charging the same rate since 1958. Western Union's been doing the same thing for 140 years. So finance really wasn't touched by the internet, and that's basically what blockchain is. It's bringing the internet to finance. It's connecting, billions of people ultimately together without having to pay some kind of, oligopolist control on the payment rail. And you're going to use cryptography to, protect and provide trust rather than, legacy financial institutions.
Yeah, I find it so strange that it had like a 20-year lag, Dan, until we finally found the internet of money. And, I actually had a 2-year stint in New York City as the CFO of a dot-com startup from 99 to 01. And I was part of the group, where I was just all in on dot-coms. My finance buddies would meet me for drinks and they would just say, please stop talking about this is the next biggest thing. I said, it's Columbus in the New World. And we rode that up and we rode it back down. But like you said, finance didn't change. And even fintech, and London's one of the great centers of fintech, it always seems to be like a tech plug-in to an old school system, like internet banking, where it never actually innovated. Why do you think there was that 20-year lag? Was it because the blockchain hadn't yet been adopted? If the blockchain wasn't adopted or Bitcoin didn't exist in '09, would we still be waiting for this to happen?
Oh, I think so. Satoshi Nakamoto nailed it. There were decades of attempts to do it. Adam Back's Hashcash before that, and a bunch of projects like that were really close. Some gold-backed tokens, but they all lacked one or two of the key ingredients. And Satoshi put together a handful of those concepts into the first fully functional digital currency that used decentralized trust. And, then you're off to the races. So, who knows if Satoshi hadn't invented it, it might have taken, 2 more years, might have taken 20 more years. But a perspective to have is there's kind of an impatience. And I remember there was a time when people said, oh, it took the internet 20 years to happen because it took 20 years to go from Netscape to, Google and Facebook. But it took 20 years to get to Netscape, right? Like it's been a 50-year journey to get from the original creation of TCP and IP to get to what we have now on the internet. So blockchain's 12 years old, so it's just at the beginning. And that's why I'm so excited. I think there's another 20 years of just absolutely fascinating disruption to come.
Yeah, it's a good perspective. I know a lot of people in the industry or in crypto and DeFi, they want it to happen faster, right? Because they see it. But when you take a look back, it's actually happening quite fast. And
yeah, it is. And I love that you quote that serial killer line. One of the reasons I love using it is to remind people it will happen serially. It's not going to all happen overnight. And in the bubbles and the manias, everybody thinks Bitcoin and blockchains can change the world overnight. And then when it goes down 80 or 90%, like it has many times, people are like, oh, it failed, it didn't do anything. In reality, it's slowly marching through hundreds of different use cases. Some of which, like wealth storage, cross-border money movement, it's already great at. 8% of all the U.S. to Mexico remittance is going over Bitcoin. That's awesome, right? Like, so it's already very useful. But, like refugee aid, it's not gotten done yet, right? Or voting rights, which ultimately blockchain will be hugely impactful. That's like 20 years from now. Another one, well, Wall Street back offices. Someday they will all be on a blockchain. It's going to be like 20 years from now, right? So all this stuff has to happen in its own good time. And I was just thinking, one other analog that's helped a ton of people is to think of what blockchains could do to finance is the same as what VoIP did to the telephone monopolists. So when I was a kid, AT&T controlled every phone in the United States. And if I wanted to call somebody in England, I had to use British Telecom. And it was really expensive. Like, you really were conscious of how many minutes you were on an international phone call. Then they realized you could route voice over the internet. And so the amount of information that now goes over the internet literally wouldn't fit over copper wires. There's not enough copper on Earth to run what is now the internet. And obviously broadband costs are basically zero. That's basically what's going to happen in finance is now you can route money over IP. So you don't have to use these expensive middlemen that provide trust and move money around. Anybody with a smartphone can communicate with anybody else on Earth with a smartphone. And that is going to do what it did with voice, is going to bring a massive explosion in the number of transactions. And the cost is going to head towards zero. And it's going to open up all kinds of new things like micro labor and things that just are not possible in the current finance world.
Yeah, and it's good to put the banks in perspective. I think you've said, banks are basically still the same as when the Medici set them up in the 15th century. And as you said earlier, credit cards charge the same rate they did in 1958. Some of these transfer systems are still 100 years old. And that's what the blockchain is going to bring. There's this book called The Innovator's Dilemma. I'm sure you know this concept that the innovation can never come from the industries that are already associated or owning the space because they don't want to eat their own profit margins. And we've seen banks get into fintech. But do you think ultimately it had to be this peer-to-peer blockchain thing that would bring all the innovation? I mean, would it have ever come from inside a bank or from a fintech startup, or would it always have to be something like this? Or does this just make it grow faster?
Yeah, I mean, I'm sure there are some examples of some legacy firms that have kind of disrupted themselves, but most are much more like Kodak Film. Kodak Film invented electronic cameras, Wi-Fi, digital file storing of photos, a ton of really innovative things, but they didn't want to roll it out because it would cannibalize their print film business and ultimately ended up failing. And so there's a few examples, I'm sure, counterexamples against that, but it's likely that it's going to come from the outside because these finance firms, have hundreds of billions of dollar market caps. They are certainly not rushing to provide a product that ultimately will let anybody with a smartphone send money to anybody else with a smartphone without paying them anything. And the fees are, very high. The average remittance fee is 8%, right? So the migrant spending an entire month working for their remittance company with Bitcoin or other blockchain assets on their smartphone, they can send it essentially for free. So, there's not going to, the legacy firms they're playing, a very slow dance with blockchain.
Right. And like, I think you've also said, if you want to send like $1,000 to the UK, it's literally quicker to get the cash by suitcase and fly here and give it to someone with the old system, not to mention the fees. And yeah, you're right. They will probably come slow to that dance. And that's why this market's also so interesting. Let's talk about Bitcoin, because you put out some pretty interesting, ideas about, first, when you started looking at it, I think you saw this incredible linear correlation or logarithmic correlation between simply the number of users and the price, regardless of anything else. And I've seen some of the presentations you put out that I think are probably available on your Pantera website, where you tracked simply the adoption rate versus price and found this incredible correlation. And then on the back of that also predicted some potential forward price points for Bitcoin. Can you talk about that idea and then when you first realized that?
Yeah, so there's a lot of reticence about Bitcoin or other cryptocurrencies because they don't have cash flows. And I had a fun conversation with a Tiger Cup friend of mine that's a TMT investor, and he said they don't invest in Bitcoin because there's no cash flows to discount. And I was like, well, there's no cash flows to the euro, and nobody thinks twice about trading the euro. There's information about interest rates and current account deficits and things like that help you decide whether you want to be long or short the euro. And that's the same with Bitcoin or other cryptocurrencies, all kinds of information, how many transactions are happening, how many people are using it. The simplest concept, though, is just supply and demand. As I said, it's going to be a serial killer. It's going to go through all kinds of different use cases. And every year it picks up more people that find another use case, find something they want to do with Bitcoin. And we did publish a table that has the number of people using Bitcoin. And that's gone up an order of magnitude every 2 years. And we're now at about 100 million people using Bitcoin. In 2013, there was about 300,000 people using it when I got started. And obviously, there's only a handful in 2009 when it was released. And the really wild thing is if you then put next to that the price of Bitcoin in each of those 2 years, it has also gone up exactly one order of magnitude, exactly every 2 years. And I've never seen a relationship between two pieces of data that's that crazy in terms of going up 5 decimal points and also maintaining the exact same ratio. The ratio is $200 per million people using Bitcoin. That was true when there's 10,000 people using Bitcoin. It's true at 1 million people using Bitcoin. It's been true at 100 million people using Bitcoin. And that is a framework that makes some sense. The more people that want to use it for whatever they're doing with it, the more it's worth. I found in my time in the industry, the kind of the stickiness rate is massive. It might take people 5 or 10 years to get their head around it, but once they buy Bitcoin or other cryptocurrencies, they almost never want to sell it. And that's why the price just keeps going up, because there's very few people that ever want to part with it. And, every year you try and, you convince another cohort of people to come in. So if you extrapolate that out, there's 3.5 billion people on Earth with a smartphone, only a bit more than people that currently use Facebook. If all those people started using cryptocurrency and that relationship held, which, past doesn't have to predict the future, but it seems solid, that's $700,000 per Bitcoin. And while I'm not going to say I bet my entire life savings to hit exactly 700,000 on some specific date in the future, it really helps to point out the massive asymmetry of this trade. It's definitely risky. Bitcoin went down 55% over the last couple of months. So there's definitely a ton of risk in the industry, but you really can only lose one times your money in being long something. And if it has the possibility of going up an order of magnitude, it's a good risk-adjusted trade.
Yeah, and the order of magnitude is 10x for anybody who hasn't probably that engineering background or science. Have you ever seen an asset like this? And again, I think at Bankers Trust, you were doing some global stuff. So you really have seen everything. You've been in Tokyo, you traded probably currencies, mortgages, probably equities, everything under the sun. Have you ever seen an instrument like this, or with the volatility, or even with that asymmetry?
Yeah, so I did spend 25 years wandering around the earth looking for trades like this, big disruptions. Also, when I was at Tiger Management, we invested in a lot of big disruptions around the world. And so, I was in Russia when Gorbachev was doing glasnost and invested in Gazprom and some other privatizations, and Argentine farmland and Tesla Motors. And, every 4 or 5 years, something like that would come up. This is just so much bigger than all those. It is, all those things were regional or country specific, some kind of interesting dislocation just in that one country, that one region, and affecting maybe just one market, maybe just the equity market, or maybe just the bond market in Spain when they had their devaluation. So, all those trades, they were great trades, but they were very kind of localized or specific. This is so many different use cases globally, and all of those are literally the biggest things on earth. Wealth storage, gold, even money, M2's under $1 trillion. All of those markets are the biggest markets on earth. So I think it's a once in a lifetime type trade. And that's why, we went all in, and it hasn't slowed down. I really think we have another 10 or 20 years of this. So, I think it is a once in a lifetime trade. And every time I meet some, college kid that's thinking about what to do next, blockchain, I just say, hey, do this. And 3 years from now, if I'm wrong, you did something kind of interesting and, it didn't work, and you move on, do something different. But, if I'm even half right about how important blockchain will be, it's the right place to be. And so, I do think blockchain is the trade of a lifetime.
Yeah, it's interesting you say that. My daughter's 17 and she's trying to figure out what to do with her life. I actually had her on the show on Friday, and then set her up with a hot wallet afterwards. And her first assignment is to send grandma some ETH. So I'm doing my part over here, Dan, just so you know. But it's good advice. I had a choice when I graduated MIT to go work for Ford Motor Company or a place called the Aerospace Corporation in LA, or go to Bankers Trust. And for me, first of all, I could feel the energy and excitement, and I could see the upside. And I'm actually glad I made that choice. And it meant my learning curve and my earnings went 10x probably more. And, probably the same is true, like you said, with kids graduating these days. I mean, blockchain is almost the new finance somehow, right?
Oh, it really is. You and I had a great time when Wall Street was one of the most innovative industries on earth and growing and really exciting. But the robots kind of taken over most of what was fun about trading. And so now the innovation's in decentralized finance, or it's in other applications of blockchain.
Yeah. All right, let's talk about DeFi. Then I want to actually go back to some of the early days of you setting this fund up, because it's still amazing that you did it back then. You started off, well, you had no choice, because back in 2013, and there was only Bitcoin really, and that was what people were talking about. It was the asset class. It's what you invested in. But pretty soon, this Vitalik kid came around, and Ethereum came around, and we saw this programmable blockchain, which could do many different things. And now it's evolved in a massive way. You've been along for that ride. You've been all in on Bitcoin, but you've also started to invest in all these other DeFi networks. How do you describe this very strange relationship between Bitcoin and DeFi or Ethereum to other people? And how do you see this new DeFi ecosystem growing in a different way to, say, Bitcoin?
Oh, yeah, it's been fun. I met Vitalik when he was a 17-year-old reporter for Bitcoin magazine. So it's been fun to watch this whole thing grow. There's a huge amount of innovation here. DeFi as a concept is kind of another, analog of the final piece of the protocol puzzle concept, that you need a way for people to do finance transactions without a very expensive middleman. So Bitcoin has been fantastic at storing wealth, moving wealth across borders. It's already doing a huge amount of cross-border money movement. There's $1 trillion stored in it, and it's been perfect, flawless for 12 years, never been hacked, and it's never even had downtime. There's no other financial system I'm aware of that's been 24/7 uptime for 12 years in a row. Like, even Facebook or other, big sophisticated technology companies go down from time to time. So Bitcoin's amazing at what it does. And sometimes people complain that, hey, it didn't evolve or didn't change. But, obviously one of its strengths is it doesn't ever change. It's immutable. It's got, the lowest risk of any of these blockchains and has the highest security. So Bitcoin is amazing at what it does, and it's already had a great run. Our original Bitcoin fund's up 65,000%. So, Bitcoin has already done a great job. And my point would be, I think more of the future returns are going to come from other protocols, and in particular, the smaller DeFi type protocols. And if you think about it, there was a point in 2021, early this year, that Bitcoin itself was 70% of all the market cap. The other 5,000 tokens were only 30%. And well, I think Bitcoin's going to go up a huge amount, like it's going to go up like 10x over the next few years. Other things might go up even more than that. And, so we've been investing in Ethereum, Polkadot, a bunch of DeFi tokens built on top of mainly Ethereum. And those, I think, have a, just a higher amount of potential upside, over the coming, months and years. But I want to stress, this is just my current trading view. I'm not omniscient. We might be wrong. We might have to change tack. And then as well, Bitcoin's now down to 44% of the overall market. And I guess the way to say it is, Bitcoin's done very well, but the other things have gone up even more. So at this level, we are buying back some Bitcoin in our funds.
Ethereum, what are your thoughts? Will this stay the dominant blockchain and backbone of DeFi for the next 5 years or not?
I think so. From time to time, there have been some interesting projects that are going to compete with Ethereum, but I think they have the inside track on this. There's so many developers building on it. There's, just so much community. That's one of the things that Vitalik and the rest of the community have done incredibly well, is to kind of harmonize, to have a single vision of where they want to go, and to really get a lot done. And so, Ethereum really is hard to unseat. I think there are some other blockchains out there that have attributes. And I guess the preamble to this is, in our industry, sometimes it gets a bit tribal or almost religious that, some people are Bitcoin maximalists and really just can't stand anyone talking about anything else. And then, some people are potentially too passionate about Ethereum. My view is this isn't a winner take all situation. There's going to be, probably at least a single digit, if not more, number of very important blockchains in the long run with different use cases, right? Bitcoin, people sometimes say it as a compliment, sometimes slag it off, call it digital gold, but it's great. It's way better than gold. And that's why it's massively outperforming gold, even in a inflationary period like we've got now. And then there's the smart contract use case. There's, Ripple's trying to replace Swift. And then you have the high frequency, low value transactions for gaming and things like that need its own blockchain. So, I think you're going to have a handful of blockchains. And to my mind, being a Bitcoin maximalist is like being a Yahoo maximalist in the 90s. Like, Yahoo was a good company, but there's 30 other important things happening. That's the same here. Bitcoin's massively important. You should have some, you should be long it, and definitely don't be flat or short Bitcoin. But there's other things one would want to have in a portfolio. And I do think, my main advice to friends and, colleagues is, don't put all your eggs in one basket. There's a lot of really interesting projects out there.
People complain Ethereum's gas fees are too high. It's slow. We just got done with the London hard fork and we predicted those would go down. I don't know if that's happened. Is that going to change anytime soon, or is it just hard to upgrade such a massive piece of software, and should we just kind of get used to that? Or do you think it will innovate and get better faster?
No, I do. I mean, that huge hard fork going through is amazing. I think it is amazing how much Ethereum's evolved since, the crowd sale. It really is amazing. I think that's why the other blockchains that are competing with it have a real huge task, to bring out something that's radically better.
Cardano hit to be the third market cap this week. I think it went down to 4, but it had quite a pop. They hit some milestones in August. We've actually got Charles here on the show in a couple weeks. Some people believe that, Cardano could be the Ethereum you would build if you knew what was going to happen. If you could have predicted the future in 2014, maybe you would have built a different network. Obviously, it comes from very different philosophy, and I think both Vitalik and Charles would say that Vitalik is let's ship it and test it, and Charles is let's research it and bulletproof it before we ship it, right? And I think both would agree if I said them that. Do you think Cardano will become a major player? Do you think it could take down Ethereum? What are your thoughts?
Yeah, I haven't watched that for what they've done, but our bet is much more on Ethereum. And your point's well taken that we're watching economic Darwinism in action. There's been 5,000 different projects try these things, and the market gets to vote on which ones they like and move some up to the top, and some obviously have to drift down to the bottom. So it's been that, to my mind, that's the fascinating thing, that the numbers, even 2, but sometimes 3 and 4, have really rotated over the years. There's been a lot of moonshots of things that were going to be the next, Bitcoin or the next Ethereum, and most of them have flamed out. And we keep cycling through new ones.
Yeah, that market cap table moves quite a bit up and down, and a lot of people are trying to come into that space, but we'll see. It's interesting that you chart the price of Bitcoin based on users, and I was having this conversation with a guest yesterday where we were talking about Microsoft Office. Now, again, I got nothing but good things to say about Microsoft, but we're a Mac-based company, and whenever I go to someone's office, I look and I'm like, you're still using Outlook, and you're still using this, and it's not always the most innovative software, but it's so well entrenched into every single business in this world that it's not going anywhere anytime soon because it's got the most adoption. Are you with me on that analogy, or do I have flaws in that analogy when it comes to?
No, it's a good one. And the classic when I was a kid was, Sony beta tape versus VHS. The Sony beta was way better. VHS was terrible, but they installed a lot more units before anybody else, and they won, right? And so the same thing with Microsoft. They installed an enormous amount of units. It's hard to unseat them. So, it's the same, and that's essentially the argument of Ethereum. They have a lot of people who built a lot of stuff on there. So it's harder to unseat. And I'm not an expert on many of these technologies, but if you talk to a real technologist about SMTP or some of the other protocols, they're like, oh, they're terrible, but they just got out there and got enough people using it that now we kind of have to deal with it. And, that's just the reality. Once you have a pretty big install base, the next thing has to be radically better. It can't be just a little bit better.
Yeah, and it's funny, your Bitcoin price predictor, it's great for predicting the price, but it also tells you so much about the network, doesn't it? It's actually, there's another sign there saying, yeah, it predicts the price, but the reason it does this is because that adoption is so crucial, right? It's literally part of the network, and it's the main determiner of the price, which means it's like when Bill Clinton said it's the economy stupid, right? It's almost like it's the adoption stupid, right?
No, it is, right? Because there's some things that have no network effect, right? If you're the last person on earth to use a BlackBerry phone, still works. Doesn't matter if nobody else is using that. If you're the last person on earth to use a cryptocurrency, it's got no value, right? So, technologies generally and currencies have massive network effects. The US dollar being a great example. You can do business with US dollars in the jungle of Borneo, right? Like anywhere on earth, you whip out a US dollar, there's a massive network effect. You can do business. So if you have a currency that's also technology, it really has a massive network effect.
Talk to me about how you choose investments. If people go to Pantera, your website, they can look at your portfolio companies, and it's an impressive list. I listed off some of them earlier. Audius was in the news yesterday, I think, with a TikTok deal, so congrats on that. I know you had a big price spike. I know you're in for the long run, but that's amazing. I mean, 0x, 1inch, not to mention the Coinbases and the Bitstamps. How do you look at these things? How do you invest in these things? And how do you stay calm when like Audius pops like that in the day and you say, okay, but we're here for the 20-year look? Like, how do you manage all that?
Yeah, so, the space is getting more interesting. I have to admit, back in the day it was fun because there was only one thing, Bitcoin. And even that's kind of hard to get your head around. Now there's, thousands of different things to look at. So one of the things we've done is we've grown our team. We have 50 people now, when it used to be, just a handful of us. So we're looking at tons of deals, trying to figure out which ones have value. Occasionally we come into the markets with a view, kind of like a global macro style view that we want, this type of, cross-border money movement company, or we want, scalability company. But mainly it's just, we get pitched all kinds of, fascinating things. and we try and see if, the product can work, the team's gonna be able to do it. Great example, I got a cold email from Brendan Ike, and he said, hey, we've never met, but I invented JavaScript, and I was the chief architect of Netscape and the co-founder and CEO of Mozilla, and I'm doing a blockchain browser. You want to talk? I'm like, I definitely want to talk. And so, we just keep hearing interesting ideas like that, and trying to figure out whether they're doable, because, we've seen a lot of projects that come up with something in their white paper that we ultimately conclude literally is impossible. Even if you have 1,000 developers in 1,000 years, you actually can't build what's in there. But if it is buildable and the team seems like they're going to be able to motivate a community to help them, build out the project, then we take a strong look. And in our portfolio, we tried to invest in what we think is going to happen kind of in this serial era. There are we've done 3 venture funds. We're doing our 4th right now. Each of those first 3 is kind of like a geological strata, like a snapshot of the time. Our first fund was all about how to buy Bitcoin, like Bitstamp, how to store it, like Zoppo, kind of primitives like Ripple Labs, Circle, kind of just the very basics of the industry. And then that kind of got built out. So the second fund was about cross-border money movement, and mainly using just Bitcoin, not other blockchains. So invested in a bunch of regional cross-border money movement companies, things like that. But then that kind of got built out because most countries have a pretty good dominant player now. And then the third fund was much more about other blockchains, scalability, non-financial use cases. So each fund's kind of a snapshot, and that's what we're looking for now. We're just starting to raise money for our next fund, and there's all kinds of new non-financial use cases that we're investing in. Scalability is still important, and in looking at those entrepreneurs, we're looking for projects that can really make an impact. Audius, being a great example. Building a decentralized version of the music sharing sites we're all used to. And that's a huge theme for us and for our whole industry, is so-called Web 3.0, doing what we were doing with companies like Uber, Airbnb, but doing a decentralized version of them. And, seems pretty obvious that's the future.
Right, and so Audius isn't DeFi per se, but it's Web 3.0, where it's kind of blockchain based. Is that how you would describe it to someone on the streets?
Yeah, all these Web 2.0 applications that, like Airbnb, people with excess capacity for housing, with people who need accommodation, match them up. It's a great idea, but it might not need to be a 30% tax, for the rest of eternity, right? So you can build a decentralized version of many of those businesses. And the music sharing business is a great example. The artists actually get very small cut of the amount of money spent on their production, and all these middlemen, music sharing sites, take most of the value. And so if you can use blockchain to connect the artist with the consumer, you can give both of them a much better experience at a lower rate.
Right, and they can buy equity with tokens at the same time, right?
Yeah, and so the community can participate, in the value creation, and that is a big difference between protocol tokens and equity, which is funded, the .com boom, like you were mentioning. That none of the value went to the community, none of the value went to the people who built the protocols that drive, drive the internet. All of it went to the handful of companies, like the Facebooks and the Googles that got control of certain areas. And, so very little goes to the producer of the content. Facebook's a great example. 2.4 billion people spend 50 minutes a day producing content for Facebook. They don't get any value, and they actually end up paying about half of people's data bill that they're paying is paying for ads and malware that are being downloaded while they're waiting for what they actually are searching for. So doing it in a decentralized way where the community itself shares in the success, I think is obviously it's more equitable, but I think it's, the way that the future will go.
Yeah, I hope people can understand this. And, you said earlier in the broadcast, it's like everyone needs a specific analogy or story and to get it to click. The gold people need the gold analogy, that these people need these analogy. And so I try to tell the same story sometimes different ways on this show until it clicks for everybody. But Facebook's a good example. It's a great application. We gave them all our data. We met all our friends from high school. We realized we didn't want to talk to them as much as we thought we did. And guess who got wealthy? Facebook, right? And again, they provided a great app, but we got all our info, and you said we probably pay more than we think, right? The malware, the ads, and our data. This, and is that fair? Well, look, it was literally fair because we did it. Now, this is a chance where we can be a part of that upside, and we can also make the governance decisions, and we can build it. And almost by definition, since it is peer-to-peer, it can potentially grow faster than some of these other networks.
Yeah, that's a great way to say it. You know, obviously there's a huge desire to connect with people like social media is allowed, but ultimately, you know, it is very expensive one way or the other. It's either taking a ton of money out of the content producers, whether they're, you know, people just posting selfies or people recording music. The ultimate content creators aren't getting paid very much from the current system. Google and Facebook together get 98% of the marginal increase in online ad spending. That is much stronger levers than John D. Rockefeller had in the oil market, and the antitrust officials determined that was unhealthy for our economy. So, you know, those two companies have an amazing amount of power, and it's really the content producers and the consumers that, you know, are ultimately paying that.
Yeah, well, you're speaking to one. I mean, we've been on YouTube for 10 years. I think we've got 500 million views of our content. And again, it was an incredible network to share our message. But, you know, from a financial point of view, I mean, we spend, you know, millions of dollars every year producing that free content for YouTube, which obviously uses it to grow their network. And again, it's been a great starting position for us 10 years ago. But now I look back and think, what if it had been on the blockchain? What if it had been tokenized? What if there was a community? In so many ways, from a participation, from a revenue standpoint, even from a governance standpoint, when it comes to censorship issues and things like that, it really becomes obvious, right, how these two worlds will be different. And that's what Web 3.0 is super exciting, because potentially that ownership and governance goes back to the creators, right, and the consumers.
Oh, I agree. I think it's a huge theme. And again, it's not going to happen overnight. It'd be really cool if you just snap your fingers and everything would go to a decentralized version. It's going to take a decade. But I think in a decade, we will look back and, you know, both the content producers and the consumers are going to have had a better experience. And like you said, governance is a really fascinating topic. You know, many of these tech monopolies or oligopolies are controlled by literally one person. That's a very centralized version of governance. And if you let the community control governance, I think you're going to have better outcomes.
Yeah, and we see it with the wars that we see on social media of, why won't you let me say this, and this says this, and the fact checker says this, and like you said, then Congress rolls up these individuals and makes them answer some questions, and it all feels quite strange and centralized. There's got to be a better solution, and I'm guessing you're going to make that happen with your funds going forward. Audius kind of cuts out the Spotifys and iTunes of the world and tries to give the governance and money back to the creators and the community. That's roughly what that does.
It is, and you know, it's a simple model, and you know, I think it resonates with people. So it's growing very quickly because people love using it.
And the next fund you're raising, this is a big moment. Again, we're gonna dig up your funds one day, hundreds of years from now, and find out what really happened, right, in the last decade. But this next fund, I know you kind of said some of the philosophies, and again, it's hard to predict the unknown, but you know, what do you think you will be investing in? Like, what types of ideas? It's obviously blockchain related, Web 3.0, not necessarily DeFi. What are some of the ideas you're thinking about? And also, I'm curious, where are these companies located? Is it much more international than it was, say, on your previous fund?
Oh yeah, that's a great question. And we just had our investor summit recently, so we kind of did a then and now comparison of what we've invested in now versus the summit 2 years ago in 2019. And in 2019, 2/3 of all the projects we had invested in were in the United States, and 2/3 of those were within 2.9 miles of our offices in San Francisco or Santa Rosa. So half of everything we ever invested in was within a couple of miles of our two offices in California. It's changed dramatically, actually. It's now 58% outside the United States. So we're seeing a much more global distribution of projects that we invest in. So yeah, it has changed. And then I think, and that was changing, obviously prior to the pandemic. The pandemic's now kind of, made kind of distributed remote work the norm. And so I think it's going to be more, in 2 years, when we look back at this next 2 years, I think it's going to be much more distributed than even what we did in the previous couple of years.
If you had to throw cities out there, I mean, who's in the mix? Is London in the mix? Is Tel Aviv in the mix, or Singapore? Or, I mean, again, a lot of these are just maybe on their letterheads, and maybe all of those people are in different places. But are there any spots that you see coming up as being big in Web 3.0?
Yeah, so it is very distributed. There isn't really a concentration. And again, it used to be half were in Silicon Valley. Now it's very distributed. There's a huge blockchain community in San Juan, Puerto Rico. Now we have a handful of investments in China, but the rest of it really is distributed, very evenly around the world. We're probably invested in 35 different countries, which is, very different than most industries in the past.
Okay. All right. Let's talk about Pantera, because we haven't gone there yet. We've been talking about all things DeFi, but, we haven't really had anyone like you on the show to talk about investing in these instruments from a funds perspective. And I think it was a few months ago, Dan, when I was looking at this, I called up a bunch of my buddies in New York and I said, who's risk arbing this stuff? Like, who is it? And again, a few years ago, if it was the equities or FX market, you would know who it was, right? Dan, I mean, like, you could be like, all right, it's the guys in Greenwich or this, who's doing it. But then with blockchain, I always wondered, I don't know who it is. Is it some people in Russia or Tel Aviv? And then I realized, some of your funds do a lot of that, like really interesting short-term looks also at crypto and investing, including long-term stuff. What is your life like as a fund? How do you look at these things? And what are some of the instruments you offer to investors with those different risk profiles? Maybe you could explain that.
Sure. So, since we fell down the rabbit hole, we're investing across the entire spectrum of blockchain. And so we have 4 different main funds. One has daily liquidity, and then venture has 10-year lockup. So, we cover the entire spectrum of just massively liquid all the way through normal hedge funds at venture. And it's trying to offer investors, a match to whatever specific sector they want to be in or whatever liquidity profile. So our Bitcoin fund is like an ETF, but it exists. ETFs don't exist yet. That allows investors to come in any US banking day and come out any other US banking day with no lockup. So it's a very efficient way for people to get exposure to Bitcoin. And then we have 2 quarterly liquidity hedge funds. And again, there's no lockups. We're trading things, like Polkadot, Audius, that are massively liquid. So we don't need to lock people up. So people can come into our liquid token fund any month and come out at the end of any quarter. And then the ICO/early stage token space, it's now a bit slower because people want to hold things for a year to not be seen as unregistered securities. So that fund is, people can come in every month. And every quarter they can ask to come out, but it does take 1 year to get the money back because we want to be able to hold things for SEC reasons. And then, venture obviously is straightforward, just investing in equities. So that was great. And we essentially were the first of each of those things to be launched in the United States. So we ended up with 4 separate funds. What we found is that particularly endowments really want an all-in-one blockchain type fund. They don't want to pick, is it early stage tokens or is it venture that's going to be best? So our current fundraise is a fund that covers the entire blockchain spectrum, all the way from very liquid things all the way through illiquid venture and pre-auction tokens. And that's been popular. And the other 2 reasons I actually think it's a better format for now is, back in the day, equity and tokens were totally different. You would invest in projects like Bitcoin or Ethereum that just have a token and they would never have equity, or you'd invest in companies that would just be, using blockchain tech to do something better, faster, and cheaper, but they would never have a token. The world's much more complicated now, and so a lot of projects have both equity and tokens, or they start out as equity and become tokens. So having an all-in-one, this blockchain fund that we're launching, allows essentially both assets to be in the same fund. And so LPs in the fund are going to capture value, like, Brave being an example. The equity might do well, the basic attention token might do well, or, maybe one goes to the moon and one goes to zero. And so it's nice to have it all in one fund. So the investors are hedged. And then the other bit that you mentioned is there's often a huge swing between value in tokens versus venture. And we just saw it. Tokens came down 55% over the space of a few weeks. May 17th was actually the most volatile week in Bitcoin history. So huge move. But venture is very slow to change and reprice. People are still doing term sheets from 3 or 4 months ago. Entrepreneurs still want the prices they heard a few months ago. So this new fund, we're able to essentially swing with that pendulum. And just recently, we bought a bunch of liquid tokens in the fund because they were very cheap, and now they're starting to head back up. And I could imagine a time, a year or two from now, where tokens are really expensive and venture's cheap. And so we'll sell the tokens and buy into venture. And then you did mention high frequency trading. We do that in our liquid token fund. We have a quant team that's built a bunch of models over 4 or 5 years, where we trade HFT across a lot of different tokens on a lot of different exchanges, and just trying to extract the inefficiencies. And you're talking about risk arb. We're in such a primordial market. There's a lot of inefficiencies. And I'm sure they'll be arbed out faster than in the traditional markets. It took Rentec from the 60s to now to make other markets really efficient, and it probably is not going to take 50 years in our market, but there still is a lot of opportunity. So our liquid token fund does about 5 to 12% of its risk in a set of quant models, and they have been making money and providing a diversified income stream.
Who's your competitor in high frequency stuff? Is it some computer somewhere? Is it a couple other funds like yours, or is it people you have no idea where they are in the world?
Yeah, I'm not sure that many of our kind of venture competitors in the space do HFT trading, but there's a ton of HFT shops like DRW and Jump Trading and firms like that also trade crypto. And so, I'm sure they're the ones we're mainly competing against.
And there's 5 years left in this market, you're saying, probably, or more, a little more.
I think there's a long time. I would say, I started on Wall Street in 1987, and I was like, wow, this stuff's not going to last. It's all going to get arbed out. Maybe I'll go back to being a structural engineer. This thing's not going to last. And 35 years later, still a lot of opportunities. So, any prediction that things get arbed out quickly is normally wrong. I think, there's a good bit of time here.
Okay. And then, like you said, the fund you're raising for now, people wanted the whole spectrum. So you might hold Bitcoin, and you might hold some Polkadot, and you might hold some equity in the next Audius as well, kind of all in one fund to give people kind of this weird, this diversified exposure. Is that what they're looking for?
Yeah, it really is. It's trying to have the whole ecosystem in one fund, because that kind of removes the onus of stock selection basically from the allocator. And I went around in 2013 and pitched people Pantera Bitcoin fund. And I would get, the CIO of the most famous endowments and 20 other people around the table, and nobody bought it because that's really a very specific bet. One asset in one fund run by one fund manager, that didn't sell very well. On the way to the elevator, I always get, what's the minimum, because people want to invest personally, but there's no way you're going to get them to put their university endowment into that. So people want to allocate to the concept of blockchain, and then let the manager, whether it's Pantera or one of our peers, decide, which subsector to be in, venture, liquid tokens, early stage tokens, and then within those subsectors, which assets to be in. And again, like I said, throughout the life cycle of the fund over the next 5 or 10 years, we can swing, right now it's 100% liquid tokens. We're starting to invest in illiquid early stage deals and illiquid venture deals. And so the balance will probably shift a lot over the next 5 or so years. And then, the fund will start winding down.
And so, for example, say with Audius, your high frequency guys could trade Audius. Your other fund, third fund, I guess, would also have equity in Audius or tokens. And your new fund might also think, we want a position in it going forward. Would that be possible on a variety of companies?
Yeah, it is. So right now, prior to the launch of our new fund, our four funds were essentially mutually exclusive. Any asset we bought could only go in one fund. Now, this is like a wrapper of all four of those concepts in one. And so any type of asset can go in the new blockchain fund. It will be our only venture fund going forward. So we finished investing venture fund 3 at the end of June. And so every new deal from July on goes into the blockchain fund, 100% of it. When we do invest in early stage tokens going forward, they're split between our evergreen hedge fund and this new venture style blockchain fund. And then the same thing with liquid tokens. When we invest in big liquid things like Polkadot or Ethereum or Bitcoin, they will also be split. And the only exception is we won't be doing the HFT stuff in this new blockchain fund because it's more of like an institutional endowment type product. And so HFT trading is not really the right fit.
Okay. And a couple of technical questions, then I want to keep going. When you do invest in some of your kind of startup ventures now, I mean, you were talking about earlier, is it a hybrid of tokens and some equity? Do you see the market going one way or the other? Do sometimes companies have multiple different types of tokens, like a governance token and a this token? And do you think that'll trend one way or the other?
It had, there's been some big swings over the past where, tokens weren't very popular until 2017. They became way too popular, and then they went completely out of fashion. I think we're now back to kind of a normal, steady state where we're seeing a healthy mix between equity and tokens. And then from the projects themselves, there are a lot of projects these days that have both equity and a token. We try and make educated views on which one will accrue the value, but we're certainly not omniscient. So often we do invest in both because we want to have exposure to whichever direction the value will go.
Yeah, and that's a great explanation of the market. Like you said, I mean, it's got such a weird history and a lot of pain and joy points over that with the ICO boom and bust. And people, at first you couldn't get the coin tokens, and then there was too many and too many crazy ideas, and then people wanted to stay away from them. But now they're this incredible way of raising equity, right? It was never an option, say 10, 20 years ago, but then you might want to blend. So it's good to hear what it's happening, like kind of like on where the rubber hits the road when it comes to those investments. Questions about those early days and maybe lessons we could learn from you back in 13, 14, 15, 16, like trying to create a Bitcoin fund. I mean, I can't imagine the conversations you had, the weird looks, the news headlines you were battling. How did that prepare you to be the Pantera of today?
Yeah, it was a fun time. It was kind of, the basics. I spent probably 6 months thinking about Bitcoin and whether it was, a good investment or whether, we wanted to get involved. And when I ultimately decided to launch the fund, we repurposed an old fund that used to be an FX trading fund for Pantera because it was already registered in the Cayman and actually was grandfathered with a lower minimum so we could get more retail people in. But it took a while to get it all done. And so we launched it, and we didn't really have all our docs, right, and all that stuff. And it really was kind of the Wild West. All these friends in Silicon Valley and tech CEOs trying to invest in the fund or get exposure. It was actually very hard to buy Bitcoin back then. It was all Mt. Gox and, crazy exchanges. I mean, it's totally different now, but it was really hard to get invested in Bitcoin. And so people would, I had one CEO of a big tech company that sent us a few $1 million. And a couple of weeks later, he called and he said, "Hey, what are the terms?" We didn't have any documents or, any, real marketing material or anything. So it was really fun to kind of get all those people engaged. Obviously, we had a very slow going with endowments or other very institutional investors, but a lot of really interesting people from Wall Street and technology decided to invest. And a good little story about how much the industry's changed is I spent a bit of time trying to figure out what exchanges to use. And it was really, really primordial days. And at the time, Mt. Gox was 85% of the whole market. And I had visited Mt. Gox in Tokyo and met with the management, and I spent 2 days there actually, and I just felt like something was wrong. I didn't know what was wrong, but so we decided never to do business with Mt. Gox. So we needed to do business with other people. And so we set up an account with this new startup and called Coinbase, and they had one employee at the time. And when Bitcoin hit $65, decided to launch the fund because it had come down from 140 bucks or whatever. So it was, come down more than 50%. Decided that would be the day we needed to launch it. And it was actually over the 4th of July weekend. So I sent a bunch of money to Coinbase and Bitstamp. And a couple days before that to get ready. And as soon as Bitcoin hit 65, just intuition, I decided, okay, this has got to be the bottom. It's time to go. We got to start buying. And so I went in and I hit buy, and a pop-up said that my limit was 50 bucks, and not like some Wall Street people used to say in the 80s, bucks being millions, like 50 US dollars, like one Ulysses S. Grant. I was like, oh no, I'm trying to buy like, $1 million or something in Bitcoin at the time. And so I sent an email in all caps to support@coinbase.com saying, I just sent you $2 million. I want to buy Bitcoin. I have a limit. And 4 days later, I got an email back from their only employee, this guy named Olaf. And he said they were going to up my limit to 300 bucks a day. So it just shows how different the industry is. They're trading 70 billion a day now of Bitcoin.
Wow. And you invested in those companies afterwards, Coinbase and Bitstamp.
Yeah, so it was really a great example of prototyping things. We still do that a lot. We still try and use the product, obviously meet the teams. And so ultimately we did invest in Bitstamp first and later activating Coinbase. And then, many other companies that are, actually two other companies that are part of Coinbase, Tagomi and Zotbo, from being customers theirs first.
Wow. And that must have been hard to avoid Mt. Gox back in the day when that was where all the volume was. But I guess you really get a feel when you go into the headquarters, kind of like in an old school way.
And they were doing 85% of the market. I mean, it was the most dominant exchange I've ever seen in any industry. But it really just felt like a lot of stuff didn't add up. And then ultimately, they were involved in those two US federal agents that went rogue, Mark Force and the other guy's name escapes me, who they were extorting Mt. Gox, and they were federal agents. I mean, there was a lot of super strange stuff going on. And those agents who were rogue are actually the ones that seized $5 million of Mt. Gox's money in a bank in San Francisco. I mean, there was just a lot of weird, and obviously none of that was public at the time, but you could just kind of feel something really weird was going on. And I think it was October of that year that they ultimately went under.
How did you keep the faith over those years when not only there's been 90% Bitcoin corrections, but also crazy news like that? I had a guest on yesterday who said, of all the historic markets on Wall Street, the media has probably been the most disfavorable to this one. How do you keep that North Star?
Oh, there's been some dark times. I was thinking back in 2016, we're trying to raise our second venture fund. And Bitcoin had been down for 2 years. And the total of that entire year was we raised $2 million of inflows, and we had 60 million of outflows. So, there were some dark moments where it's just like, this just is not working. Like, nobody cares. So it's fun now, obviously we're maxed the other way where everybody loves blockchain and Bitcoin, so it's, there's definitely some times, it looked pretty dicey.
Yeah. That sounds like you need a movie or a book coming soon on that. That's impressive. Talk to me about trading these volatile markets. I've actually got hundreds of students right now that go through our DeFi Academy, and for 4 weeks we try to get them to put small amounts on these protocols so they can get to understand yield farming, liquidity pools, and even a basic options trade. But then we try to get them to learn how to invest in these markets. But I'm also looking at markets that go up 50% in a day, and I'm thinking no human is prepared to trade these volatile markets. And you might say, okay, Brian, I bought Bitcoin at 40,000, it went to 100,000. Even if it goes back down to 50,000, I'll be okay. But I don't believe you if you're new to trading because most people can't take that emotional roller coaster. It'll drive you to spend it before you have it, to drink, to talk to the relatives. Like, I know from being on that Bankers Trust trading floor, it took me years and years and years until I was even relatively seasoned from an emotional perspective. I think you once said, I'm probably not going to win the Nobel Prize in physiology or medicine, but I can imagine that the traits implanted on the plains of the Serengeti might not be optimal for trading early stage protocol tokens. And so maybe you can talk about that, about how humans, dealing with now mobile-based pricing 24/7 on instruments that are incredibly volatile, and all sorts of newbie traders for the first time ever, Dan, trading the markets in crypto. They didn't choose to trade in Apple or S&P futures. They're going into crypto. How do you talk to people about that emotional journey and how to prepare for it?
Just say no. No, so the point is, don't try and day trade
call up Pantera.
Crypto.
Right.
And it does remind me of a phone call I got, super early days, 2013 or so. My friend Mike Novogratz, who's now at Galaxy Digital, he called and said, "Hey, I'm trading Bitcoin." And I was like, "No, you're gambling." Because there's no information out there. Like, it goes up, it goes down. There's no way to have an edge. And I still have a bit of that view, is day trading crypto is gambling. It's not really trading. Like, there's just not enough information. We have 50 people trying to figure out what's going on, and we don't know what's going on half the time. Like, we don't know why the market's going up, why it's going down. So my main advice to people is invest the amount of money that if it went down 85%, your spouse or partner will still love you, and then hold it, right? Like, that's it. Like, don't trying to day trade and all that stuff, because things go, like you said, up 50%, down, it's just too hard. And the other point is, if you're in an asset that does for 10 years, it's tripled every 2 years, or tripled every year, sorry, which makes it go up 10x every 2 years. You don't want to be flat or short very much, right? Like, it's mainly going up. And so in most of our funds, although we have the ability to take a lot of risk off, we're pretty close to fully invested most of the time. And we try and take it off if we think the markets are overvalued or it's coming down. But, most of the value is in being long and holding for a good period of time. And a good example would be our Bitcoin fund. You can come in it for one day. You can come in on a Monday, come out on a Tuesday. So we offer people incredible liquidity. We really stress and beg to them to view it like venture. Write a check that you can live with. Don't look at it for 5 or 10 years. And luckily, our average holding period is something like 800 days now. People do hold it for a long period of time. And that'd be my main advice to your audience, is just, because you are gonna buy it at the highs and want to sell it at the lows. Like, it's human nature. And we actually put a graph on our Twitter and our website about the inflows to Pantera Bitcoin Fund. 8 years, 3 bubbles, 3 massive bear markets. It's massively pro-cyclical. Is all the money pours in at or near the highs. And we've published this thing several times after each and every cycle. We're trying to help remind people, and I need that reminding too. Like, I'm always thinking, I'm so genius when it's at the highs, and then I'm bummed, 2016 was at the lows. And so the results of that study show that the amount of time Bitcoin spent in a bunch of different price buckets is very normally distributed. Most of it in the middle of the range, sometimes cheap, sometimes rich, to its long-term trend. But the vast majority of the inflows come in way above fair value. And the important point for today is Bitcoin is now 32% below its long-term trend. So it's actually quite low relative to where it could be. And yeah, we're still down quite a bit, 35% or whatever from the highs. And we're only about double where it was 4 years ago, right? So Bitcoin is still, I think, is quite inexpensive relative to where its trend, and then obviously where I think it could be. So the advice is, when when my peers and I are on CNBC every day talking about Bitcoin at the highs, and the FOMO devils whispering in your ear, you probably don't want to be going totally every dime you have into the markets. But then times like now, where market's way off the highs. It's been down for a long time. That's probably when you do want to push, more of your resources in it.
But still, as a default, you would rather try to hold those positions even at highs as opposed to going short or even getting cash, because you're willing to stomach some of that volatility, and long term you think it's appreciated.
I think it is, and that's what we've done with our own funds. Is generally we probably averaged 85, 90% long across these cycles. And there's sometimes we take risk down. And in February, we did that quite well. We took it down right before the markets came off. This last time we didn't. So sometimes we catch it, but mainly we're trying to be long. A great example would be last March when the financial repercussions of the virus were starting to dawn on all of us. Very confusing time. We took risk down a lot, but only for 2 weeks. And by the March 25th, I think, when we sent our investor letter out, we were back to limit long, because we thought the balance of risks were to go up. And again, if you're talking about asymmetric trades, which is what, I've studied, you can only lose 1 time your money, but you might make 10 times your money, or more, like our, many of our funds. You just don't want to be flat or short, because there's a huge potential upside, and your downside is, it is limited.
Yeah. You mentioned the kind of crisis pandemic last year on March 2020, and it was an interesting moment for a lot of reasons. We had Michael Saylor on here about a month ago, and that was the moment where he kind of said, well, wait a second, maybe I shouldn't have cash. Maybe I'm not a responsible CEO if I'm sitting on cash. Maybe it should be something else, because I'm starting to see maybe what, inflation really is, as opposed to what's probably published in the indexes, et cetera. And he kind of went a deep dive. We all kind of thought this was the black swan event we had been waiting for, and then quickly realized maybe it wasn't. We also saw a lot of easing, a lot of money being printed, a lot of assets being propped up. Sounds like you, within 2 weeks, kind of changed your mind and got back in the market. What can people learn with what happened there? What do you say to people about understanding inflation, or even the whole quantitative easing, or even the value of their dollar versus a crypto asset?
Yeah, the main thing to stress is what's happened in the last 15 months in monetary stimulus is literally off the charts. In June of last year, the United States started printing more money in a month than they did in the first 200 years of the country's existence. It's just completely off the charts. So you kind of have to open your mind up and just think, what's going to happen when you print that much money? It has to inflate the price of things whose quantity can't be eased. And that is what's happening, that anything that has a fixed quantity is going up in value. We did put a graphic in our investor letter and on Twitter that shows the price of things essentially inverted. So it's really actually the price of the dollar priced in number of ounces of gold or grams of sugar or bales of cotton. And in my opinion, that's really the thing that's moving. All the rest of that stuff is kind of staying the same relative to each other. It's the value of paper money that's plummeting right now. And so you see that against everything. We even put lumber in there, everything that you can't just kind of make more of instantaneously is going up in value, and the value of paper money is going down. And it feels like we're accelerating. The amount of monetary stimulus that's coming we just keep dialing it up. And the numbers are pretty staggering. For each of the last 2 fiscal years, the budget deficit is $14,000 per adult in the United States. I mean, that's a lot of money, right? And then to put it in perspective, the cost of a vaccine dose is $14. So we're spending 1,000 times the value of a bit of medicine that would actually stop the virus, kind of papering over the impacts of the virus. So, it really is staggering amounts of money that are being printed, and it has to impact things. And the best proof of that would be that in a global pandemic, when corporate earnings were being destroyed, the S&P hit a high. That's excess money. Like that's and there's all these great stories of like Hertz raising money when they're in bankruptcy because there's so much money being shoved at it. There's just a lot of paper money going around, and it really has to cause inflation. And, you know, you quoted Milton Friedman earlier, his great line, inflation is always and everywhere a monetary phenomenon. It might not be true for like plastic flip-flops or whatever, but for things whose quantity can't be eased, like housing is record increase in the median home price in the United States in a depression. Like, I mean, it's really wild, right? So there's just so much money being printed that it really is pushing up the price of all assets.
And so, again, I had this conversation with my 17-year-old daughter here in the studio on Friday, and you know, she's never owned crypto. She doesn't take economics courses, but even she, Dan, she said, okay, but who's going to pay? That's what she said. She's like, who's going to pay for all this? And I couldn't really answer her question. So I guess I'm going to ask you, like, we all see this. We all see it happening. Obviously, smart money is diverting itself into non-inflationary vehicles like Bitcoin and some crypto assets. But how does the party end? You know, where are the chairs when the music stops, in your opinion?
Yeah, so if you want all kinds of analogs, there's a great line by the former chairman of the Fed, Chesney Martin, that said, the role of the Fed is like a chaperone at a party to take the punch bowl away right when it's heating up. And I mean, I feel like the monetary authorities are like an F1 driver spraying champagne on the crowd right now. Like, there's so much money getting out there that it really is creating excess. And, you know, who pays for it? It's a really good question. You know, unfortunately, I think the answer is it's groups that are subsets of society, like renters. You know, 63% or so of Americans own a home. Flooding the markets with money, driving mortgages down to 1.25%. Massively positive for people who own a home. It's horrible for the 38% of Americans who don't. So there's a huge transfer of wealth going from renters to homeowners. Same thing with net worth. The United States just printed record net worth, household net worth, but it's not evenly distributed. It's for people who own equities, people who own homes, people who own businesses. And for those that don't, this is a huge transfer of wealth. So, you know, well, it kind of feels like your daughter might say, well, who's going to pay for it? I mean, I think that's the answer. It's the people who are not in the typically majority groups, homeowners, people who own equities, either directly or indirectly through their pension plan. Those are the people that are benefiting from this. And the people who are not in those groups are being disadvantaged.
Yeah, it's really down to the kind of the lower income or even maybe lower educated that haven't crossed that gap of owning assets, which is, you know, they don't teach this in school. You know, they don't teach you how to buy assets in school. I never knew how to do that or what that might mean. In the UK, we paid furlough checks to people, which was to supplement their income for many months, and maybe even it's coming up on a year. And I remember someone was like, well, who's going to pay for that? Well, you're going to pay for it through your taxes, through the devaluation of your currency, but you're probably going to pay double what we gave you ultimately. And the asset holders and the other people won't pay. And that's the strange thing about this paradox is it almost redistributes wealth while we're doing this.
Oh, it does. No, and unfortunately, I think that's going to be the subject of some really fascinating studies over the next 4 or 5 years is the massive wealth redistribution because of the monetary and fiscal policies that have just been implemented.
Yeah. And just to reiterate the point you made earlier, as humans, we have a tendency to buy high and sell low, right? And yet when I got to Bankers Trust, they said, your job is to buy low and sell high or sell high and buy low. Either way, do it. But like our natural emotions, funny enough, are to do the opposite, which means when all the hype is there, fear of missing out. And then, you know, when it starts hitting the lows, we just think, you know, oh my gosh, it's panic time. And so you have to almost train yourself out of that or not play that game. Agreed, crypto day trading, you got to have your head examined. And these days, like when I was at Bankers Trust, you know, Dan, I could trade mercantile futures on the Singapore exchange if I called them at night, right? Otherwise, my liquidity was removed from me, right? These days, you got the mobile phone with the blinky colors and the thing that has been adapted from the gambling industry, right? To get your attention, now showing you prices and then news that get you to transact. So people really need to not be crypto day traders. I forgot what the figure is, but it's something like high 70, 80% of lose money on a regular basis. So they need to really resist the temptation to go do that and to try to find either a disciplined strategy or someone else to do the trading for them. Is that what you'd say?
Oh yeah, that's my suggestion is, figure out what you're able to risk and then, put it in a potentially diversified basket of assets, not just all in one. And then try and hold it for years. Anyone that's ever held Bitcoin for 3.25 years can make money. So, if no matter what, and there's been 83% on average bear markets in that. So here's another great stat on Bitcoin is although we've had 4 massive bear markets, 83% on average, just had a 55% one. In the last 10 years, there's only been 1 year that's printed a new low. So if you are able to hold it for a multi-year period, at least historically, it's always bailed you out. I actually think it's true going forward that, if you buy any cryptocurrency now and you hold it for a few years, you're probably going to get, a profit. But that's the main point is, don't get over your skis when everybody's going crazy about it, and then don't, liquidate, at the lows.
Yeah. A couple final questions about you. Dan, what's your biggest challenge right now? I mean, from the outside, people are looking at your funds and then liquidity and the 2.8 billion and you're raising money now. I'm sure a lot of it's coming in, but I'm sure you also have a lot of challenges. So what is the biggest challenge or the biggest couple challenges for you this year?
Yeah, actually, it has been just to try and keep growing, to be able to handle the amount of interest in the space and the amount of deals. We're seeing a record amount of inbound deals. We keep a stat for our investment committee that we have each week of how many deals are live, that we haven't yet funded it, but we haven't yet rejected it. So, they're still alive. And that averaged about 8 for most of the years. We're at 25 right now. So we have 25 deals we're trying to process. So our biggest challenge is to, hire enough people to be able to really do some thoughtful work and, be able to handle this opportunity. Because I do think it's a once in a lifetime trade. So, you can't wait for the next set of these waves to come in. You got to, get your surfboard out and grab these. So our biggest challenge is trying to staff up, and be able to process, what is happening here. Other than that, I do think we have, 5 or 10 more years of the market's been super interesting, super dynamic. So we're really excited.
You told people to go into blockchain. Again, back to my daughter, she's about to go to university. Can you go to university for blockchain, or do you have to learn that somewhere else? And the reason I ask is because I'm sure recruiting for you is not the easiest thing, and definitely not easy for your portfolio companies. So how does that work? What's the best way to get education, and how are your portfolio companies hiring the best people?
Yeah, so that's the beauty of a permissionless system. Anybody can participate. You just need a smartphone to be able to be in the blockchain ecosystem. So the main thing is just get involved. Go join your college Bitcoin club or blockchain club. You start reading. There's a ton of great stuff to read these days. Get on firms like ours, investor letter lists. There's a bunch of websites that aggregate news, and just start learning about the industry. There's actually meetups that are really fun to go to, meet other people in your community that are excited about blockchain, and then try and get an internship or get a job at a company in the space. Start learning what's happening, just to get in the flow of what's going on.
So don't go to university.
Yeah, it's funny. We had a guy drop out at age 17 to go full time with us, and I was like, wow, it's a new era.
Wow, and you got him? You hired him?
Yeah, we had a guy drop out of college when he joined us at age 17.
Wow, and he was obviously adding value. You could see that right there. You went to Princeton. I'm sure you had an incredible experience. I mean, I think you rode heavyweight crew, and I lasted about 4 days on the MIT crew team, by the way, until I realized how hard it was, and I couldn't walk for like 4 days after the first practice. But I really relished my experience there. It was so important for me. I was in a fraternity. I learned. I had to manage my own schedule. And when I again look at my daughter, I just maybe it's nostalgia, Dan, but I'm thinking this is an important experience for her. but I also can't point to the best blockchain school in America because there probably isn't one. So how do you feel about that, that conundrum?
Oh, there's a great Mark Twain line that I never let my schooling get in the way of my education. And that's what I would suggest to kids like your daughter. Go to college, have a great time, learn all those things you need to learn, relationships, all this important stuff, and then go get a job in Bitcoin or something else. But those 4 years are super important for lots of other reasons. And you can learn all the rest of this on the job. I didn't study Bitcoin in college. So, if you can learn something that's relevant, like some CS or some economics, that's helpful when you're in college. But so much of what college is about is not in the textbooks. So that, definitely kids stay in school, have fun while you're there. And then, when you graduate, get into business.
Yeah, I'm still pushing for the college experience. Final thoughts, where is Pantera 10 years from now? I mean, everything goes even better than you expect, Dan. Where are you guys? Maybe from assets under management or just things you're doing, or what's the future?
Oh, so we want to be the best fund manager in the blockchain space. So we're going to keep growing, keep scaling so that we can manage both hedge and venture funds as well as anybody else in the space. And so, we don't want to get into other, merchant banking or, lots of these other things that some of our competitors are doing. We really just want to stay focused on being very good at fund management. But I think the industry is growing. It's a $2 trillion industry now. Our few billion is a very small fraction of that. I think the industry is going to be 10 times bigger in 5 years. So hopefully we're at least 10 times bigger ourselves.
But you could be running $100 billion or more at that point. Who knows?
Oh, it's definitely possible. We're big believers in how this is going to scale. And, a good example would be, DeFi, recently went to 100 billion of outstandings, which, we've been invested in companies like 0x since there was zero exposure in the DeFi space. So, we think it's awesome that we're up to 100 billion, but there's 100 trillion of bonds, right? So we have 1,000x of headroom in DeFi. Some firm, hopefully it's Pantera, but some firm in our space is going to be, 100 billion in 5 or 10 years.
Last question everyone's dying is, how can they get involved in Pantera? I've got a few buddies in New York that are invested in your funds. They got amazing things to say about you guys. What's the minimum to invest and how do we do that? And what would you suggest for maybe new people to start off? Would it be the high frequency or would it be a venture cap fund? Just final thoughts on that.
Yeah, so we've always been about trying to educate the community because this is a new asset class that we're evangelizing. So we do have conference calls every month. They're open to anyone where we're talking about the themes we see that we think are important in the space. So if you haven't already seen it, on our website we have the times and dates of the upcoming calls. We send out an investor letter roughly once a month. We miss a couple here and there, but and that goes through all the really important things we see in the space. And then very importantly, has a big list of all the books, websites, podcasts that we think are informative in this space. So it's a great way to get educated on the space. And as far as our funds, we try and keep it as accessible as possible. Most of our funds have a $100,000 minimum. And then, I think a good portfolio would be half in our early stage fund and half in our liquid token fund. It has a lot of liquidity, covers the entire spectrum of tokens. So it's a great place to start. If you can invest for 10 years, then our new blockchain fund is a great way to go. But not everybody, can lock up money for that long.
And is that more like $1 million minimum, or you can still
that
do
one is $1 million. It's a much more institutionally focused product. So unfortunately, that one is $1 million. But all the rest of our funds are $100,000 minimum.
And you were saying even the fund, I think it was the high frequency fund, you said, where you can get liquidity every day. The average holding was 800 days? Is that what you said?
Yeah. So, luckily people have, really believed in our mantra that it should be treated like venture, even though you have a lot of liquidity.
Yeah, that says it all, in my opinion. I guess you know that too. And it kind of doesn't surprise me. I guess you give them the option of liquidity, but once they see what you're doing, they're like, you know what? We want to leave you to make those decisions. And I guess they're voting with their frequency. So yeah, those are great stats. Dan, just want to say thank you for your convictions. I mean, it's almost hard to believe that you were doing this back in 13. I mean, in 2013, I had a conversation in my old studio, which was my kitchen, with Max Kaiser, where he was screaming about Bitcoin, and I had just tried to buy some on an exchange for $85, and there was no liquidity, and it was just this, Wild West. And to imagine you were out there pitching institutions for funds and setting that up, it's, again, hard to believe, and I know a little bit about that side of the industry, and it's, it's not one that responds to newness very well. So yeah, just appreciate the conviction. Your funds these days are really exciting. They're really understandable. And yeah, I'm probably going to be giving you some money soon. So thanks so much. If people want to learn more, go to Pantera and your website and basically get on your newsletter and conference calls and then go from there. Is that the best thing?
It is. And Brian, thanks so much for having me on. And thanks for what you're doing to spread the word too.
No, I appreciate it. It's been super exciting. Like I said, I haven't felt like this since like the 90s at Bankers Trust. And I was in the dot-com startup boom as a CFO, but I never felt like I was really invested. We kind of all had a little piece of equity and it disappeared. Whereas in this market, I feel like we can all own a bit of it. So it feels like I'm more involved in the upside than ever. And I guess everyone feels that. And the education side's amazing. I mean, we have a kind of a high price point academy experience where 4 weeks they all get a community and they learn by doing, and the response has been amazing. The energy, as you know, in this community is kind of off the charts, super positive, super tribal, which is good and bad, and also really exciting. So yeah, congrats on what you've been doing. It's great to see your portfolio is popping like Audius and stuff, and yeah, to be continued. So all the best. Thank you so much for the time.
Hey, thanks for having me on.
All right, and thanks everybody for watching. Go check out Pantera, and we'll see you next time on London Real. Take care.